Let's give folks a couple minutes before we get started here. Why don't we go ahead and get started? Good morning, everyone. Hi, everyone. My name is Karina Rao, and I lead ParaFi's investor relations team. We wanted to welcome you to today's session of our virtual fireside chat series. Today, we'll be hosting the CEO and co-founder of M0 Labs, Luca Prosperi. ParaFi is an investor in M0, and one or more of its managed funds may utilize the M0 platform. Please note that this fireside chat is not to promote, endorse, or recommend ParaFi's advisory services or any fund managed by ParaFi, nor is this a recommendation of any particular investment, protocol, security, or other asset. The views discussed in this chat are the views of the individuals and not of M0 or ParaFi. This fireside chat is being recorded. We are excited to offer these fireside chats and hope that our audience respects the intimacy of the event. While there is no formal duty of confidentiality, please do not repost specific quotes or views from the discussion to Twitter or other social media. As a reminder, we encourage everyone to submit questions during the discussion. With that, I will introduce our speakers for today, Ben Forman, Managing Partner of ParaFi, and Luca Prosperi, the CEO and co-founder of M0.
Thanks, Karina. Luca, thanks for being with us.
Thanks for having me.
So for everyone who's joined today, thanks so much. I'm humbled to be joined by Luca today. Luca is one of the founders of a ParaFi portfolio company called M0. But what's I think unique about Luca is not only is he a founder in the crypto space, but he's also been a long time, one of the deepest thinkers about DeFi, about the stablecoin landscape, and has had an entire career in investment banking and traditional markets. So he really brings a very deep and interesting perspective on the space. So I'm incredibly excited to have this discussion today. There's so many different topics we could cover. But I want to really start with, Luca, your background and what drew you into crypto to begin with. Maybe we could start there.
Yeah, thanks, Ben. Thanks again for having me, for the kind words. Yeah, I'll try to make it relatively short, but I think there are some interesting connection points. But as you said, I started my career in a traditional finance. Actually, I've been consultant, advisor, investor in financial services companies all my career. Started my career as a strategy consultant for banks at Oliver Wyman between London and continental Europe. Joined Morgan Stanley in their financial institutions group doing M&A between New York and London after business school. And then went to the buy side, first to co-manage a hedge fund that was of a couple $1 billion that was investing in credit and equity of financial institutions, and then in private equity. Surprise, surprise, investing in regulated financials. So I think I've done, I studied and lived in financial institutions all my life. And by the end of my traditional, around I started working right before the financial crisis. So this has been around 15 years. And towards the end of my traditional finance career, it was becoming kind of clear to me that banks were phenomenal liquidity venue. They were very, very good at managing liquidity, but they were not as good as product platforms. Spinning out products for banks or understanding the needs of customers for banks was not the most efficient. There was an efficient way. So towards the end of my career, when I was representing on the board financial investors in a regulated bank in the Baltics, which is a place which is very fintech friendly in Europe. I asked myself, okay, why can we use the liquidity of the bank to provide financing to alternative lenders, the mini lending clubs of this world. They were like very innovative fintechs, for lack of better terms. They were very good in creating products, very good in managing channels, but they didn't have a balance sheet. Typically, they were financed by hedge funds or family offices at very, very high IRRs. And I was thinking, okay, we could do the same. We could undercut those capital providers and lever up those assets, those good assets in a bank, and have achieved 20, 25, 30% ROE on the loan book, which is pretty good in banking land. And I started to do it. We put together a portfolio of a couple of $100 million. And then COVID hit. COVID hit, the portfolio did very, very well. I was doing less well personally because I went through a very unexpected cancer prognosis the first week of COVID, which was an interesting story per se. I don't want to indulge into that, but obviously it's very important in my life. But so I spent 6 months in isolation studying, and then I started studying these alternative liquidity venues that were the beginning of DeFi, the compounds, the Aave, and the makers of this world. And to me, those were even more efficient liquidity venues compared to banks. They were very, very efficient way for asset providers to post the collateral and be financed at very good cost of capital by those protocols. So I decided that, especially after encountering illness very young, I decided that the value of my time was high. I didn't want to waste time, so I decided to join what I thought was the next generation of financial services, even if in its infancy. But there is a connection here. I always found we have seen financial institutions as a bundle of infrastructure and product placement or marketplaces. And in my mind, financial infrastructures can be divided. So I've been always very fascinated by the infrastructure part of it. And to me, DeFi and crypto rails were the next evolution of that. So I joined the space with this, because of this type of interest.
Yeah, that's fascinating. I mean, when you first stumbled across, I don't know if it was MakerDAO or Compound or Aave, but the first when you first stumbled upon DeFi, what stood out? Like, what were the salient features for you, and what caused you to kind of hit pause and really spend time on it?
Yeah. I mean, I was quite familiar with the balance sheet of banks and how banks were making money. And even if banks, and I'm generalizing obviously, but most of the banks, or the banks that were not too successful in reinventing themselves, even if they were trying to create service fees by cross-selling their platform, their business mainly was creating money, because banks create money out of thin air, by receiving collaterals that are typically treasury bills or sovereign bonds and mortgages. So a system where someone asks for financing of an asset. Let's say you ask to receive money to buy a house. You ask for a mortgage. You pledge this house to the bank, and the bank prints money, puts that money in your bank account, and you can do whatever you want with it as part of the regulated system. And that spread between the assets and the liabilities is the main business of banks. And actually, after the crisis, most of the banks were making money by carry trading their cost of liabilities that is very low, and the fact that they could buy sovereign bonds, especially in Europe, which were yielding more. But this very simple business is very complex in the bank to manage, because it requires agencies for collecting deposits, it requires underwriting, it requires compliance, it requires monitoring of the assets, it requires collateral management. This stuff is very cumbersome. And when I saw Maker, for example, I was fascinated by the fact that Maker was reinventing it in a very streamlined way. You have an asset that has some sort of market and recognition of value that is digitally native, like Bitcoin or ETH. You pledge it and you receive money that is printed by the protocol out of thin air, but has recognizable value because the holders of this currency, they know that there is sufficient collateral backing it. And it was doing it in a very, very streamlined way. In the same way, the Uniswaps of this world, for people who are familiar with it, reinvented market making in a way that was stripping out probably 95% of the overheads. And having spent a lot of time in banks with a lot of friends after business school that instead went to Web2 companies like Google and Facebook's, I knew pretty well that banks needed to step up their game because they were living on a technology stack which was 20, 30 years older. And I think that was what stimulated my interest. And as you were suggesting, I actually started my journey in DeFi as a researcher. I started researching this and publishing about those topics before getting involved in the project and before becoming a founder myself.
Yeah, it's fascinating. I mean, similar thesis to mine on just like the idea that software is a very low cost of capital, relative to banks. I think one of the interesting things about your project M0, and I think we'll probably get to it in a second, is you really started focusing on MakerDAO and the DAI stablecoin and thinking about that system almost as a central bank on chain, money created through credit, as you said. That is one of the different, DAI is one of the many stablecoins that has kind of existed or stood the test of time. As you think about stablecoins, like as a technology, what in your mind makes stablecoins special? And maybe take a moment to talk about the different stablecoin models overall and how they vary. I mean, we could spend, you could probably spend a couple hours on this, but maybe just on a high level for people on the call that are less familiar.
Yeah, I mean, even before getting to stablecoin, I always define myself a money nerd because I think money or currencies in general, we joke that are the most sophisticated, mass adopted products there is, because money does so many things and we just ignore it and we just use it because it works. So you use a dollar, but a dollar is very complex. There is a huge value chain. It's printed by a central bank that is some sort of independence with the government, but it's kind of backed by the power of the government to collect taxes or pay back its debts, and is distributed through the banking system, and there are different types of money, and it's very complex. The stack is very complex, but it works. So people just use it. They don't even know what it is. And I think that the fact that it's so efficient, it allows many people in the stack to make a living for themselves. So the government, for example, the US government, thanks to the fact that the dollar has been a reserve currency for many years, finances itself below probably market rates. The rates they would get, a similar borrower with a similar type of leverage will probably get. If you are a company with the same level of leverage of the US government, probably will not get the same level of interest rates. And the banks, they do the same, right? Because banks are printing additional layer of money that goes in the pockets of the ultimate users, and they keep a spread between what the government asks and what they give to the customers. I'm obviously simplifying, but I think money is a very, very complex and fascinating product, and it works very, very well. But it's and it's not been the same forever, right? I mean, the way we were distributing money 50 years ago or before Bretton Woods was very different from now, and probably in 50 years will be very different from the way it is today. And that's what actually fascinated me of Maker. I think of all the protocols in DeFi that talk about, or the stablecoin minters, I'll get in a second what a stablecoin is and how it's actually produced. Maker actually is the closest to the way the traditional banking system works, but super streamlined. There is Maker generates money out of thin air, so expands the monetary supply, but not backed by nothing, right? Is backed by certain assets that have a recognizable value, recognizable market that can be very, very liquid. What others do is less revolutionary. So the reason, stepping back, the reason why stable coins, which stable coins are some sort of like tokenized version of money, tokenized version of the dollar. That's why it's called stable coin. It's like a stable coin because it's stable compared to the crazy volatility of other tokens. But ultimately, it's simply we have cash, we have bank deposits, which is already digital money. We have bank deposits or digital money 2.0, which is stable coins. But there are the way the reason why they've been so successful is that they are useful. There is a big part of the crypto space which is fascinating that still has to prove its value. We're talking about the creation economy, the distributed computing system, and so many use cases that will most probably emerge, but they're still in the future. Stablecoin as a system as a settlement tool, international, 24/7, super smooth, that can move very, very efficiently. It is needed. It is needed everywhere. Like it's needed if you're in Latin America and you want to settle. I spent significant time in Latam, and you want to settle value internationally. You cannot do it through the banking system. You can do it through the crypto rails. If you want to move money within the digital economy, you can do it through stable coins. I mean, the reason why stable coins have been successful is that there is an obvious use for that, but it's still a drop in the ocean. Like if you take the float of stable coin in total, it's probably between 150 and 200 billion dollars, which is, I don't know, it's probably a tenth of JP Morgan's balance sheet alone or something like that. So the success is driven by the fact that there is obvious use and necessity for settlement. But the providers of stablecoin have provided a stablecoin in a very, very different manner. Although they're all called stablecoins, they're not all the same. So you talked about Maker, which to me was the most interesting one. Maker is some sort of streamlined credit facility that creates coins based on assets, over collateralized by assets. So there is $100 billion worth, let's say $100 million worth of ETH, and Maker can allow you to print $50 million of stable coins. You can use it. It's backed by recognizable collateral. So that's one way of looking at things. But on the other side, you have the Circle version of stablecoins. Circle is a company. It's not a DAO. It's a company, traditional company in the US, and their approach to stablecoin is very, very banal, as you would say. You just come with $1, you deposit $1 from your bank account, and they give you a crypto version of the dollar, and you can go and play in crypto the way you want. Now the difference is they keep the dollar in the treasuries and they invest it. And 3 years ago they were investing it at 0. Now they invested at 5%. So suddenly they're becoming interesting business model, because if you have a $50 billion of float, then you have $1.5 billion of interest income, risk-free, which is not bad. But in terms of functionalities, they are not reinventing anything. They're just adding functionality on top of something. They're actually taking the money and depositing in banks and a bunch of like super safe assets. That also means that they are inheriting certain peculiarities of the banking sector. The 5-10% of the money that Circle mints was actually deposited in Silicon Valley Bank. If Silicon Valley Bank would have gone under, Circle would have gone under with them. So it's a very centralized, very efficient, very streamlined way of creating this crypto dollar, but not innovative in terms of the way the money is distributed. Then you have also others like Tether, which are centralized, non-regulated, and they are like the far west of stablecoin design. I'm not too much of a fan of that type of design, but it's very successful, and the inventors and the managers of Tether, they make a lot of money, so we cannot ignore it. What we've been trying to do, and I can get there in a second, it's somewhere in the middle. We have been trying to innovate money and money supply the way we have learned from the Maker system, which to me had and has its own flaws, but doing it in a way that is technically savvy and also compliant with regulation across the world.
yeah, that we like to say, if you don't believe in Bitcoin, you don't believe in Ethereum, you don't believe in NFTs or decentralized compute, you can still probably appreciate the value of a tokenized dollar, because tokenized dollars are faster to settle, easier to send, can for the most part involve less counterparty risk depending on the structure, and they're working today. And I think last year there was $7.2 trillion of stablecoin settlement on top of Ethereum. So it is one of like, I would say, a handful of use cases in crypto that is, to your point, kind of like very much here and now, and addresses just a huge and somewhat inefficient market. I think this is probably a good time to just transition into M0, because M0 is, many different things, but kind of maybe one of the core components of it is a new stablecoin. And so could you maybe just share a little bit about, how would you describe M0? What problem is it solving, and why are you choosing to spend, these years of your life focused on this particular problem and vertical?
Yeah, so when I started, me and my co-founders, we started studying and working in DeFi. For us, DeFi rails, or crypto rails for financials, especially in the space of like stablecoin design, for example, like in the makers of this word are great, ultimately, capital allocation tools, right? They move value around in a way that is sensible and resilient. So ultimately, they are capital allocation tools. And in my mind, the banking sector is a capital allocation tool, plus a few other things. They do services. You deposit money in a bank not only because you want the interest rates of the bank, but you want to use your money through your credit cards in a way that is efficient. So there are services they give you, but the banking sector is a capital allocation tool. And we are designing M0 to be a capital allocation tool. So in our vision, we have the way if you see a financial institution today, it's a vertically fully integrated institution that is a front office for your clients and is a proprietary backend. They manage all the complexity, and this is very unique. If you look at the publishing sector, this was the way publishers used to work 40 years ago. Now with the internet, the backend is completely abstracted, and if you're a publisher, you're just managing your website. The rest doesn't. That's where the value is. And in our mind, this will happen also to financial services. Now that we have, so I agree with you that stablecoin will still exist without Ethereum, but I think stablecoins without Ethereum would probably operate at 2% of their potential. I think that the fact that now we have a distributed computing allows us to manage financial value with the same flexibility the internet was managing information. So we can split this, we can separate this stack. So what we are doing with M0 is we are creating a decentralized backend for the financial institutions, for the financial services industry. So if you want to move value around, you can use, hopefully, you will be able to use M0 which is going to create certain primitives that allow you to move value around. Like, I'll get to the first one, which is the most important now in a second, but stake certain amount of financial value to be invested in a certain strategy. And it's a way we think that the securitization market is an intermediate phase, because we're already doing it. We are not tokenizing, digitizing mortgages, but we're putting mortgages in a securitization vehicle, and we are tranching it. We're issuing notes out of it. So we want to do this. We want to bring this to the next level. So M0 wants to be a capital allocation tool designed in a way that can be used by institutions, because certain institutions have certain requirements. The requirements they have in identifying where the flows of money come, gating or not gating what they want to accept, and being able to play certain roles within the ecosystem, etc., etc. And certain things cannot be done in the current protocols that exist in DeFi because they were not designed for institutional use. So, if I make an example, we were trying to connect the financial institutions industry at Maker, but if you're a financial institution, you connect to the protocol, you don't even know who is your counterparty. And regulatory-wise, DAI doesn't even have an issuer. And the idea of decentralized issuer doesn't exist. So who are you actually talking to? Who is actually taking responsibility of the currency you are actually taking to invest in certain assets? It was okay until now, but now it's not okay anymore. So I think we need to think about this decentralized infrastructure in a way that can talk to institutions with their requirements. Some of them are antiquated, but some of them are in good faith. It will still exist. So that's what M0 will be in the future. But the first product, let's say use case that M0 can spin out, which going back to what we were saying before, it is the capital allocation tool par excellence, is a new stablecoin. We think the stable coins that we have today are subpar. We can have better, and I think M0 can be used to issue a new stablecoin. So I was giving you two examples of stablecoin that we have today, simplifying. You have the Maker type of stablecoin, over collateralized on digital assets. It's a very solid system. It has an issue, it doesn't scale. Because obviously, when are you actually pledging a collateral to have money? So you're levering up this collateral when the market is going up, because you actually want to lever up on those assets. So when the market is going up, the availability of this type of stable coin expands, but then contracts, and it's very procyclical. It's not really great because it has its own concerns. On the other side, you have the centralized version where you actually pledge $1 and you just receive a crypto version of the dollar, but you're exposed to a lot of other risks. You're not optimizing the financial stack at all. You're taking that dollar, you're just putting it into a bank account, and then you have the counterparty risk of the bank and the frictions of a bank. So the way we are thinking that institutions could actually use this M0 to generate a stable coin is by pledging in the same way users pledge ETH or Bitcoin to Maker to get DAI. Users will be able to pledge US short-term treasury yields to M0 and pledge a stable coin out of it. So if you are a holder of $100 million of USD bills, you can pledge it and you can mint $50 of stablecoin and you can distribute it in the market. So there are huge benefits for this. Like the holder of a stablecoin are exposed to way less risk because there is pretty much no counterparty risk whatsoever in this construct. It's like having a super senior tranche of a securitization that is backed by treasury bills. So very different from money in Silicon Valley Bank. And so it's very, very solid. And for the minter of this stablecoin is a way to leverage risk-free rate without any durational mismatch. So it's very attractive. Ultimately, what we're doing, for people who are familiar with this, we are opening up the banking, a big part of the way banks make money to everyone, every holder of assets. So this type of leverage of treasury bills through the minting of deposits was the realm of commercial banks. Now, through M0 could be available to everyone. Now, the way we're doing it is we want to give the ability to regulated issuer to do it. In Europe, you can have an e-money license, so you can print an e-money token or a payment token in a way that is backed by legitimate collateral, the way we are designing it. So so if the regulator comes to M0 and wants to understand who actually is the issuer of the stablecoin, there is an issuer and he's a regulated issuer. The difference is the complete backend is be completely abstracted. So any type of regulated financial institutions will be able to mint a stable coin that is hyper solid, hyper robust, can be where the backend can be used as a service by everyone. So that's our ambition. And the market we want to tackle at the beginning is the market there is today, as we were saying before. Now there are probably between $100 and $200 billion of stable coins that are issued by issuers that, in my mind, are subpar. And that's a huge market that we want to attract at the beginning. So it's very exciting. We are trying to do things in a way that is as regulatory compliant as possible, because it talks to as many regulators as possible in the world. But this is obviously challenging because, as you know, the regulations have been written for a technology stack that was different from what exists today, and also is protecting certain existing interests that are trying to defend themselves, as always happens when there are technological shifts. But we're very comfortable that we will be able to do this, not making too many enemies, but actually making more friends than enemies in this space.
So just to tease out like kind of the exact mechanics in a very kind of simple first principles manner. So if I have $100 worth of treasuries, and let's say I'm a regulated institution, I can post those to the protocol, borrow against it, similar to a repo, borrow, like kind of effectively mint stable coins against those treasuries, and then distribute those stable coins into the market. And you effectively have a stable coin that's backed by treasuries, a stable coin that's maybe more decentralized than existing stable coins, or more censorship resistant than existing stable coins, and potentially a stable coin that can access some of the treasury yields generated by the treasuries, as opposed to stable coins today that, you know, Circle USDC doesn't pass on any yield directly to holders. Can you kind of tease? Can you kind of like actually expand upon that, or restate anything I said that's incorrect, and kind of describing mechanically exactly what happens?
I think there are. It's 80% correct, and obviously we can double click. There are many aspects of it. But let's say that you are a regulated institution in I don't know, in a certain jurisdiction, and let's say you're regulated, you are approved issuer to issue e-money instruments, or money transmission instruments, or payment instruments, whatever the jurisdiction is calling it. Now you also want to issue stable coins, for example, and you don't want to recreate the whole stack yourself, because why should you? And you also have a lot of fixed income assets, as you said. So you can pledge those assets to a collateral manager, let's say, which is like a securitization issuer, which is separate from the protocol, is a separate company from the protocol. Now we are also developing that company. We actually have acquired a securitization servicer that we are repurposing for this use. Will be one of many approved by governance, but I will not get there because things get too complicated. But you want to, unless you want, of course, but you pledge $100 million worth of treasuries to that through a servicer are deposited into a trust, let's say, or a special purpose vehicle, or a special purpose bankruptcy remote entity, in the same way you would put mortgages in a trust to issue a securitization. You know, we're not reinventing anything here. Now, the protocol will know that there are $100 million through an Oracle system, that there are $100 million worth of treasuries in that vehicle, and allows the depositor to mint up to $50 of stablecoin, as you suggest. So to mint that stablecoin, you need to pay the protocol some money, some fee, right? So the protocol is making money by charging a fee to the float of stablecoin it generates, which is very, very lucrative. From the depositor, from the issuer perspective, they're like, as an issuer, you're levering up your T-bills, because you're not invested 100, you're actually invested 50. And if you do the return calculations, instead of having 5% of yield over 100, you probably have something like 8.5, 10% of yield over 50. So you're levering up your yield in a way that the way we're designing it's resilient to a bank run. We are isolating out liquidity mismatches. The reason why we think is better is not only censorship resistance for the holder of the stablecoin, it's a completely different risk profile of the stablecoin, because there is no bank counterparty risk. There is no money deposited that can, I mean, you have $50 worth of stablecoin, they're backed by $100, let's say, of US T-bills. So the only reason, the only way you could actually lose your money in the current system is in the case of a very, very deep default of the US issuer, which obviously will be a problem. Of Circle is very different. You know, if one of the depositors go under, then the whole stablecoin breaks. So I think it's way better for the holder, and for the issuer is a way to lever up their yield, is a way to offer an additional service in case they want. And going back as an example of the way we're designing this system to be useful for institutions, the issuer could actually have the ability to wrap or unwrap the stablecoin. What I mean with this, they could actually decide to use the infrastructure to offer their own branded version of stablecoin, because as JP Morgan, you want to have your JP Morgan coin, but they could actually decide to make the stablecoin fungible across the network, because every issuer is issuing the stablecoin in exactly the same way. They are exactly the same, they are fungible. So you might decide actually to issue a stablecoin that is fully fungible across the network, because obviously you don't want to break fraction the liquidity. So this is another example. But your intuition is correct. When it goes back to getting back the yield, there are different ways of looking at it. So first of all, in the example you had for the issuer, it is correct. Like, you want to issue a stable coin, you're not sending money to Circle and Circle is giving you back a token and they're clipping the difference, and they might give you some sort of rewards back, but rewards is just a reward, it's not any right. In this case, you're actually retaining the vast portion of the treasury yield. But actually, we are designing the protocol in a way that other actors in this system could access the yield. Make you another example. Let's say that ParaFi, as an example, or another institutional investor is holding a significant portion of stablecoin for liquidity reasons. Now, if you need to have the stablecoin because you're market making on the stablecoin, or because you need to have liquidity on the stablecoin, and for any reason, now you hold the stablecoin, you don't make any money. If you want to have that asset, the yield that is backing the stable, you should off-ramp it and deposit it in a traditional deposit account to get or buy bonds. We are designing M0 in a way that if you are a regulated institution that has, not a retail institution, but an institution that has the right actually to engage with financial products, you can actually stake the stablecoin yourself at the protocol level and receive indirectly a vast portion of the assets that are backing the stablecoin yourself. So, and that you can see how we are actually closing the loop. Like, we are using M0 as a capital and yield allocation tool. M0 that allows institution to mint stablecoin in a way that doesn't depend on a central counterparties, that is clipping the vast portion of the margin without actually adding so much value. But it's also a tool that is allowing the holders of the liquidity to access the yield or a vast portion of the yield back. This is the beginning. Now, obviously, you can expand it to many other types of asset classes, and then you can start using M0 to actually stake and receive yield in regulated asset in other asset classes, that in the same way the securitization market does it. So it becomes a proper three-dimensional capital allocation tool. But that's the phase 2 or phase 3 of our roadmap.
So just in terms of phase 2, so like phase 1 is short-term treasuries. Phase 2, as you think about whether it's muni bonds or investment grade bonds or high yield, how will those yields get? How do you think about phase 2 in terms of mechanically how those yields kind of get delivered to your stablecoin holders?
Yeah. So we will not accept any other. We will not. Governance, we are creating a protocol that has its own governance, right? So governance might decide to go somewhere else, and we might decide to fork the code and create something else. But let's say the spirit that what we are designing is not to accept any other asset to back the stablecoin, which is not US short-term treasury bills. Because I think this is, personally, I think this is a huge flaw of some of the stablecoin designs that we see today. Because ultimately you're creating a race to the bottom. People have the incentive to pledge the worst possible collateral to get the stable coin and then sell it in the market. And actually they are short your stable coin. If there is a problem in your stable coin, it's easier for them to pay back their loan. So we are not going to do that. the stablecoin is always going to be backed by the same asset, one asset only, which is US short-term treasury bills, which is the best proxy to the sovereign risk of the dollar, which is the currency we are pegging our stablecoin to. But we will provide the ability to use that infrastructure. 90% of the infrastructure is actually the same for approved parties to offer access to strategy. So let's say you're Blackstone, and you want to provide an ability for liquidity providers to invest in a AA corporate bond US strategy, let's say. Now, if you have a stable coin, let's say that you have a stable coin we have designed because we think is a good one, you can stake it in that strategy fully on chain, and the manager of that strategy, in a regulated manner, exactly the way securitization market works, could actually take that liquidity and use it to invest in the assets they have advertised, and actually then bring back the assets within the yield within the vehicle. That doesn't mean that this, yeah.
Just how would it get the liquid? Like if I've staked $100 of your stable coins on Blackstone's high yield strategy, how in the kind of on traditional rails would Blackstone get the $100 to invest in its high yield strategy, and then the coupons or the interest it earns, how would those get passed back to those stakers?
Yeah.
Oh, I think you're on.
I kind of lost you, Ben.
Okay.
Yeah,
can you hear me now?
Yeah, can you hear me now?
Yeah. Did you catch that question,
Yeah.
or do you want me to?
Yes, I can.
Okay.
Sorry, I lost you for 10 seconds. Yes. Yeah, no. I got it. I mean, the construct, and that's why for us it's a phase 2, is obviously based on the fact that the stablecoin is liquid. Because if the stablecoin is not liquid, it's actually not useful. But let's assume that we can get to phase 2, so the stablecoin we have, or other stablecoins we will approve, are liquid. That means that the receiver, like the Blackstone of this world, they can access that stablecoin that is being staked. They can sell it in the open market through a market maker and receive dollars and invest the dollars in the strategy they are managing. Now, the reason why we're designing this the protocol in a very abstract way is that in the future, this step might not be needed actually. And in the future, there might be ways to invest directly stable coins that are considered robust to buy assets directly on the chain. So there is no need to off-ramp and on-ramp. And we are designing a protocol that is ready for the next phase. Now, when I told you that we are actually building two things at M0, I mean, these are two things that you as investors, obviously, as you know, you're exposed to the both things that we're doing. We are preparing the protocol that ultimately will be launched and will be decentralized. And the reason why we're decentralizing it is not because we want to hide our own liabilities, it's because we think we want to create an infrastructure that can be usable by everyone and can be as flexible as possible. But we're also building the first servicer. And the first servicer is actually the bridge that an institution will use to talk to the protocol. So if the protocol has certain requirements on how the assets are stored, certain requirements or how the data feeds move between the protocol and the real world, and we are preparing the servicers that can do that. In the same way, you will have an center of this world being a servicer of a securitization vehicle. We are preparing the servicer that can work in the new system. We debated a lot about whether the servicer itself should incorporate also some sort of market making facility to off ramp and on ramp. And ultimately we decided to answer your question. And then ultimately we decided not to, because we think that a good stable coin, in any case, we think the good stable coin needs three parties to work. A good issuer, which is a party that issues the stable coin and is backing it with solid collateral. In your example you made before, let's say a bank that holds US Treasury bills that can be stored in a bankruptcy remote sleeve, so there is no any counterparty risk whatsoever. good liquidity venues. The stablecoin needs to be liquid, needs to be used, so needs to sit on as many exchanges, centralized or decentralized exchanges as possible, because the reason why Tether is so successful is that Tether is incredibly liquid. So people use it. So people park money there because even if they know it's not great, but they use it because you can actually use it. And the stablecoin needs to be stable. And to be stable, we are creating arbitraging opportunity to make sure that the stablecoin is stable, but you need market makers. So in the same way you need market makers to stabilize the stablecoin, you can use the same market makers to off-ramp and ramp the stable. Because the idea is that if the stablecoin is trading below par, there are the incentives for the market makers to actually buy that stable with real dollars, use the stablecoin to access the treasury that is backing it, which is almost $1 and making money out of it. So the same market makers will be used by the financial institutions to off-ramp and ramp the dollars they want to invest.
Got it. Okay, that's helpful and makes sense. So I guess just pulling on that thread a bit, I want to talk for a second about growth. So you're going to launch this network, and from first principles, I think it is incredibly compelling, and it just seems as though it's really kind of like the best model that we've seen to date attempted in the space. But there's a question of how do you kind of break that cold start problem in terms of getting on the flywheel of the finding users who are organically open to holding the stablecoin, issuers that are willing to mint it, getting deep markets for liquidity. How do you kind of stimulate that flywheel and get to a critical mass where people are, say, using M0 stablecoin instead of using, say, USDC or DAI?
Yeah, I mean that is as always is going to be a challenge, and I think I will be on many flights for the remaining part of 2023, many planes. But so first of all, we are designing the system to have this ammo, the ammunition to incentivize these parties. So we want to give a phenomenally efficient leverage venue for large holders of treasuries, because we think that if we give the ability to treasury holders to make 10% risk-free, pretty much risk-free yield on the treasury they hold, it is compelling. And we want to have a very, very solid design, because we think at some point the risk of holding the tethers or the circles or the DAI of this world are going to be excessive, and we want to be there. We already dodged a bullet with the SVB debacle, but there will be others. And we have a system that can actually incentivize participants. So a way to actually access this underlying yield by market makers or institutions that hold large portions of liquidity. That is what we're doing now. Now the next step would be, and we have received a lot of interest informally by financial institutions, because every financial institution that is sophisticated enough is looking at these rails, but they are worried to engage because of all the issues that the crypto industry has gone through recently, like unsatisfactory governance, probably subpar design, and some of the reasons that pushed me personally away from the existing protocols to create something on my own. So I think there is already interest, but we want to use the weapons that we have created to develop a go-to-market strategy and bootstrap this ecosystem. Obviously, the fact that we have great investors, including ParaFi, is facilitating this, because obviously, not every investor is the same, not every team is the same, and access is very, very important. And it's something we will focus on the second part of the year. And personally, as a founder, I think that the next round of funding we will do as a company, we raised our seed. It was a very large seed. It was a $22.5 million seed, which was probably the largest of recent times. But we will go back to the funding market, and I think we would like to give equity exposure also to investors that have the intention and the ability to connect us to asset managers of financial institutions that want to use this system. So they also will get the equity benefit or the token benefit of bootstrapping an ecosystem. because I am convinced that, you've known me before you decided to invest in us, and you know that we became friends and respected each other because we have our own criticism of the existing sector we invest in. I am convinced that the stablecoin market would be massively disrupted because the players that are dominating now are not at par. It will happen, and we want to be there when it happens, because this sector is gigantic, and it deserves better designs, I think. I mean, we don't forget how much we owe to the existing protocols, how much we learn, but I think we're ready for the next iteration. But it's going to be challenging. We need to convince large players to trust us. But I think we have the right tools. We actually announced today our chief commercial officer that joins the company, Chris Molley, who is based in New York. He was the head of digital assets for Customers Bank in the US, which was one of the banks that successfully created a digital asset program, almost by like serendipity. But he was the creator of that and decided to go 100% in a crypto project. And also, we will soon announce a chief of strategy that is going to help us expand this ecosystem. I cannot mention the name; it will come in August, but I can mention that it's probably one of the 3 most senior stablecoin builders in the world, and it will leave the company to join M0. That's a great testament to what we're doing. But I think the quality of the people is going to be the most powerful success factor there, but it's not going to be easy.
In terms of the biggest challenges, if we're talking, say, 5 years from now, and M0 was not to have succeeded, what would be, in your mind, the most likely reason why? And as a kind of like a corollary question, it's tough to, not mention kind of the regulatory environment, especially over the past week. M0 has really been architected, to your point, to kind of to be regulatory compliant, but you've kind of touched on in different parts of the conversation. Can you kind of just maybe like elaborate like a little bit around how you think about what it means to kind of build a product that's regulatorily compliant in the stablecoin category? So kind of both of those 2 questions would be fascinating.
Yeah. And yeah, I mean, you're touching on the like obviously on the most important point. I think there are 2 main there could be 2 main reasons why M0 specifically could not be successful. First of all is, it is execution risk, right? We're trying to do something that is very ambitious, has many components. We think we are well equipped to do that, but there are many components and it's complicated, and there is always the possibility that you don't pull it off. I mean, we can create something that has huge potential. We know it's difficult, and that's something that exists in any project, including ours. The second one is regulatory uncertainty, and we have responsibility for it. And not we as M0, but we as a sector. And I think that I strongly believe that the shift in the way we manage money is going to happen. Now, if it happens within our lifetime or it happens in 50 years, it depends on us mainly and on the quality of the conversation we have with the regulators. Because it is undeniable that the existing sector is trying to protect itself, as it always happens. But we as disruptors should not give the incumbents very easy reasons to point their finger and say that the crypto space is absolutely not creating any value and it's a dangerous place. And us, as we didn't do a great job as a sector, right? Not me personally, not us personally, but we didn't do a great job. And that means that today it is very, very difficult to have the political capital to sit with the regulator and debate about the need to update certain regulations, because they were written for different technological stack. So I think regulatory uncertainty. We spend significant amount of money with top-notch legal advice, But sometimes our legal advisors as well, they tell us, we think that what you're doing is very, very strong arguments not to be considered in a certain way by the regulators, but it doesn't mean it will not, because the current situation is that there is a lot of regulatory uncertainty, and regulatory uncertainty is very bad for business. We would love regulatory clarity and a way forward, and I'm not the first one to say that that clarity is not there, especially in the US. So I think that is going to be the main risk. But we think that what we are doing is actually not the riskiest, because like what we are trying to create is a project that has governance or non-stablecoin tokens and stablecoin tokens, to simplify. And we are not trying to use our stablecoins, our governance token, as a way to access retail capital as a pseudo security at all. Our governance tokens will go 100% to investors like yourselves, and there is no intention for us. Actually, we would love M0 to be governed by some sort of on-chain consortium of sophisticated parties, and I personally don't think that those parties should be retail. Our project will not have a forum, will not have a Discord, will not have an airdrop whatsoever. At the same time, I'm very comfortable in defending the fact that the stablecoin that we will mint through M0 is not a security. It is a payment token, and to have to do that, is way easier than trying to convince that some sort of digital asset is or is not a security. We are creating a payment token, something that doesn't generate yield and is backed by high quality collateral and should be used as a means of payments. The rest of yield generation and access to yield will be done in a way that it should be intermediated by institutions. So what I'm telling you, I was telling you before, is what I see front end and back end, with M0 being the back end of financial institutions, is that we are very happy to connect with the front end, which is regulated. So like, I think we will be very happy to be the consultation layer of the JP Morgans and the Goldman Sachs of this world to do the capital, and then for them being the front man with the public in a regulated manner, right? So we want to be one step remote, and I've always been convinced that DeFi is actually a B2B play, it's not a B2C play. So I think that is the risking us significantly, and that's the way we are designing it, right? We are designing an infrastructure that wants to engage with sophisticated and regulated institutions that know what they're doing, to operate, to be actors in the system. And the stablecoin is a first product, is a product that is good for everyone. In the same way, money is used by everyone, but it doesn't mean that everyone has the right to print that money. So in the same way, we're designing M0. Our digital version of the dollar will be in the hands of everyone, but not everyone can print it. And before I finish, I just wanted to give an anecdote here. Is sorry, I have a phone call here. Sorry, I apologize. There is a reason. There are a couple of reasons why we call them M0. The first one is we think that the stable coins that will be produced by M0 are actually the closest comp to cash. And if you look at the theory of money, you have M0, M1, M2. M0 is cash, and M1 are bank deposits. So for us, the stable coin actually generated by M0 is not bank deposits wrapped counterparty risk. It's actually cash, or as close as possible to cash. And the second reason is we think M0 could be the base layer of many other use cases that can build on top, like the layer 0 of monetary transformation. So that if we bring various types of assets through this capital allocation tool on chain, there are so many things you can do. Then you suddenly can do market making automated through those on the chain. You can have derivatives on chain. You can basket those stuff on chain. You can settle them on chain. And there's so many other things that we hope that M0 will facilitate. In the same way, Ethereum has facilitated a lot of use cases on this distributed computing ledger. But we are ambitious, but we are very focused on the first phase 1, which is big enough to make us all excited and nervous. So hopefully we will manage to do it and navigate regulatory uncertainty. We are the most protected end of regulatory uncertainty, but obviously we are exposed to that. It's undeniable.
Out of curiosity, on the topic of CBDCs, central bank digital currencies, do you view CBDCs as a potential threat or risk to, M0's vision? As an example, if the Fed issued a digital asset that was redeemable for dollars held at the Fed, so effectively zero counterparty risk, could that kind of suck the air out of the stablecoin space, or if not, why not?
I don't think so, for a very simple reason. So I think stablecoins designed well, or in the way we are thinking about it, if successful, are going to hurt the banking sector, because they will steal part of the margin that banks do. And entrepreneurs like myself, we have no problems in doing it, right? We have no problems in disrupting the banking sector. It's a big sector to disrupt. Now, the regulator or the banking sector itself, it is a different story. So launching CBDCs means de facto killing the banks, because banks will not be the intermediary of money distribution anymore. And then how do they survive? They will not mint deposits. They will not. If you are a depositor, why on earth would you deposit money in a regional bank and not directly at the Fed? You would do it at the Fed. So how a bank would actually finance themselves? Okay, they will receive some sort of charity line by the Fed, but then the incentives are messed up, because then you're not responsible for your own liquidity. So I think that the CBDC project will kill the banks, and that's why they will never do it. That's my view. I think that the CBDC, it's not coincidence that China probably has the most ambitious CBDC, because then ultimately the state controls all the banks, so it doesn't make a difference to them. I think the CBDC, the iteration of CBDC that would be more successful would probably be some sort of wholesale currency, which is a settlement tool between the commercial banks and the Fed. But it's just a centralized ledger, nothing more. So that is my belief. I think my belief is that the stablecoin designs or digital dollars that are created in a different way are huge threat to the banks. So the tech disruptors have no problems in disrupting the banking sector. Now the banking sector will not disrupt itself, I kind of suspect.
Okay, that's interesting. I think we should have probably allotted 2 hours for this conversation, but we only did one. So I think unfortunately we have to end a bit early. There's some Q&A, and so we may have to follow up with people that have questions. Luca, first of all, this was a fascinating conversation. Thank you so much for just taking the time and sharing your views on the space and your story and your vision for M0. What's the best way, if people want to get in touch with you, the best way for them to do that?
So I exist on social media. So I exist on Twitter, and it's my name and surname, so it's at Luca Prosperi. Same for LinkedIn, although I use Twitter way more to engage on ideas than LinkedIn. I was saying before, I still try to publish on a monthly basis my own research. At least there is a huge archive about what I was publishing in the past, and I still do it on a monthly basis on a Substack called Dirt Roads, dirtroads.substack.com. And obviously, which has been way more successful than expected. I have around 30,000 readers a week, but I still try to reply to everyone who emails me based on the articles. So. And obviously, I have my email, which is luca@m0.xyz, with 0 as a number. So I'm sure that people who want to reach out will not have problems. I'm quite responsive typically.
Sounds great. Yeah, and if anyone wants to chat with Luca, they can always also ping the ParaFi team. So anyway, Luca, this is great. This is fantastic. Really appreciate your time. What you're building is absolutely fascinating, disruptive, and it'll be very interesting to be on your journey and kind of help chart your progress in the coming years. But thanks again for taking the time.
Thanks a lot for inviting me, and very happy to have another Q&A session if needed. I'm always here.
Sounds great. Okay, thanks, Luca.